Welcome to CFTC Talks. I'm your host, Andy Busch. As always, there's a disclaimer at the end of the show that's important for you to hear. Well, happy 2018, everyone, and I hope everybody survived the holidays and family get-togethers. You know, my personal goal was to only gain 5 pounds, and since I'm an overachiever, I think I surpassed that total by December 10th. So now it's time to get on with New Year's resolutions and exercise. And of course, one of the things we resolved to do here at the agency is to be transparent, right? And to this end, I've been asked some questions and inquiries into what I actually do for the agency. My mom's included in that list. So today, I thought we'd start off talking about what a Chief Market Intelligence Officer does for the agency. And then we can talk about some research my group, the Market Intelligence Bureau, has created. And actually, I believe this is the very first CFTC quarterly market review and outlook. We'll publish it soon, and I'll send out a tweet about it from at MIB CFTC. So what is a Chief Market Intelligence Officer? It's kind of a fancy title. I like that. Well, it's a brand new role for the agency. So let me provide a quick overview and some context. Now, the agency already has a lot of experts in all of the specific markets, from swaps to FX to ag. But the chairman wanted someone to provide them with the context or market narrative that was driving values. If you don't have context, it's harder to understand how your area of expertise fits into the wider structure of the financial markets and how the market narrative impacts your space. And maybe this information can help people here begin to anticipate where problems are developing. Either way, it's an important piece of the puzzle that was missing for the agency, and this is one of the reasons why he brought me on and we created the role of the Market Intelligence Officer. To this end, we formed a new group within the agency called the Market Intelligence Bureau, or MIB. Now, Chairman Giancarlo wanted to have research created to cover market dynamics, liquidity, and fragmentation to better understand how our rules, regs, and procedures interact. For both internally and externally, we are creating research to develop information material to help increase understanding of the markets, and in turn communicate that to the public. So starting in January, we will release our first report, the 2018 Q1 Market Review and Outlook. You can find it and subscribe to it by going to CFTC.gov and clicking on the Market Data and Analysis button. Check it out. So also for the show today, what I thought might be helpful would be to give you a taste of what to expect on this report. So we'll get to that in just a sec. But let me wrap up, the rest of what I do for the agency. So clearly, you're listening to it, the podcast. Yeah, it's been a lot of fun, and it's also a great way to learn more about the markets we watch by getting a wide range of experts on to tell us what they know. Now, we've had members of Congress, we've had chairmen from other agencies, we've had private sector strategists, Bitcoin and virtual currency experts, and we even did a very first of its kind CFTC roundtable discussion on how the agency developed the policy towards virtual currencies. I think that's one of the most popular ones that we have put out so far. It's all pretty cool, and thanks to you, listeners, thank you. We've already had over 17,000 downloads, so many thanks. And lastly, for my role at the agency here, by reporting directly to the chairman, I'm also engaged in a wide range of policy discussions and will be helping advise the commission and communicate those to the public. So I get to learn and advise on a wide range of issues, from fintech to CCPs to commitment of traders report to virtual currencies. And all of this wraps into the role of the Chief Market Intelligence Officer at the CFTC. So that's what I do for the agency. Now let's talk about the markets and the quarterly review. In 2017, I think the three biggest stories were these. Number one, low volatility. Number two, persistently low inflation. And number three, the flat yield curve. So as a regulator of the derivatives markets, we're charged with enforcing the Commodity Exchange Act and ensuring our clients are protected against fraud and manipulation. So to this end, we monitor and surveil the markets every day, looking at commodity price movements. As well, we research and read market analysis to understand price movements. So from the financial media to investment blogs to financial services companies research to books to discussions with market participants, we try to cover a wide range of sources on our quest to understand the markets we watch. The 2018 Quarterly Market Review and Outlook report is geared towards explaining the current market narrative driving values in the markets the CFTC regulates. So the market narrative is a living, breathing, emotional animal that is not based on econometric or statistical analysis, although those may play a role in its makeup. As a warning, the market narrative is fickle and it changes its mind frequently, and it can be inconsistent in its reaction to information, data, and facts. Yet we believe it is critical to analyze it to better understand the impact of CFTC rules, regulations, and procedure. So the quarterly will have two sections, one covering the major themes and one covering some very specific markets or contracts. So for the show, I'm just going to cover the section on the major themes. In the markets we regulate, there are numerous topics and ideas influencing values. However, we believe that they can be grouped into three dominant themes: central bank policy, U.S. domestic policy, and technology. Now, this report is not meant to be a deep dive into any and all of the key issues or variables, but as a big picture guide for readers to help you understand what is driving the markets. With this as our goal, we will review the current market narrative on central bank policy with a primary focus on the Federal Reserve, on the U.S. Federal Reserve. Ever since the 2008 financial crisis, global central banks have acted to intervene in the financial markets to foster functioning capital markets, stabilize prices, and generate economic growth. Now, generally speaking, the process was to lower interest rates with the assumption this would increase the willingness of banks to lend and borrowers to increase their investments, or firms, or consumption, consumers' behavior, right? That's what was happening here. Thus, the central banks believed that they could influence the level of employment and output. But they all encountered a problem. What do you do when rates fall to zero? This is where central banks got creative and began various forms of asset purchases and lending or credit easing programs. With these extraordinary measures, the bank's goal was to expand their balance sheets and increase their monetary bases, or the liquidity in the financial system. Since the 2008 financial crisis, the major central banks have used a wide variety of programs to achieve this goal. Initially, the Federal Reserve and the Bank of England expanded their monetary bases through purchasing bonds. The European Central Bank and the Bank of Japan initially focused on direct lending to banks before shifting over to the US and UK structures. The Federal Reserve, the Bank of England, the Bank of Japan, and the European Central Bank all engaged in various forms of extraordinary measures. Now, overall, these four central banks have been successful in achieving the goals of stabilizing credit markets, increasing economic growth, and achieving price stability. And as we start 2018, these banks are in various stages of changing or considering changing monetary policy from extraordinary measures towards policy normalization. For the markets, the unknown is whether these banks can reduce liquidity without disrupting their financial system and their economies. So let's talk about the Fed. In 2017, the central bank raised interest rates 3 times by 25 basis points each to achieve a 1.25 to 1.5 target range for Fed funds. Now, as well, the Fed began a program of balance sheet normalization, or quantitative tightening, in October to reduce the size of its $4.5 trillion balance sheet. For the markets in 2018, the focus appears to be on 2 areas: the number of interest rate hikes in the coming year and the impact of quantitative tightening on the U.S. yield curve. At the December 13th meeting of the Federal Open Market Committee, or FOMC, the members provided their predictions for future rate hikes, and the majority of the members forecasted 3 more hikes. That would be for 2018. This would take the Fed funds reference range from 1.25% to 1.5% up to 2 to 2.25%. As of this writing, or as of this podcast, I should say, the markets are pricing in only 2 more interest rate hikes by the end of 2018 via the Fed funds futures contract at the CME. For both the market and the Fed, the pace of the interest rate hike expectations is driven by the expectation for increased economic growth and rising to stable prices in the United States. So currently, Q4 GDP is modeled to be growing at about 2.8% by the Federal Reserve Bank of Atlanta in their GDP Now model. and 3.9% by the Federal Reserve Bank of New York in their nowcasting model. Again, going back to their December 13th meeting, the FOMC statement said, inflation on a 12-month basis is expected to remain somewhat below 2% in the near term, but to stabilize around the committee's 2% objective over the medium term. Now, the Fed's favorite or preferred method of inflation is the PCE ex food and energy, and this remains solidly below 2%, but it is rising. For these reasons, the Federal Reserve is also reducing the size of their balance sheet. Now, the bank currently holds, as I said, approximately $4.4 trillion worth of securities comprised of U.S. Treasuries, agency debt, and agency-backed securities. In October, the committee began a program to gradually reduce the holdings via a series of rising caps. So this is from the Federal Reserve's website, and you can look it up there as well. For Treasury securities, here's how this thing's going to work, okay? For Treasury securities, the cap will be $6 billion beginning in October and will increase in steps of $6 billion every 3 months until it's $30 billion per month. Now, the cap for agency securities will be $4 billion per month beginning in October and will increase in steps of $4 billion every 3 months until it reaches $20 billion per month. Now, the terminal caps are expected to remain in place at their maximum amounts until the committee judges that the Federal Reserve is holding no more securities than necessary to implement policy efficiently and effectively. On April 20th of 2017, the Fed did release a research piece on how their QE program reduced the term premium in the yield curve by 100 basis points. So for all you listeners out there wondering what the term premium is, it is the excess yield investors require to commit to holding a long-term bond instead of a series of short-term bonds. Pretty straightforward. If the Fed completely reversed QE, the yield curve, in turn, could potentially reverse the 100 basis points of reduced term premium. So combined with the anticipated 75 basis points of Fed fund hikes, the market narrative appears to be debating whether this may cause the entire yield curve to shift upwards and slightly steepen. That would be like 75 basis points versus the 100 basis points. However, since early September to the end of December, the U.S. 2-year yield has increased 63 basis points, or gone up 63 basis points, and the U.S. 10-year yield has gone up just 36 basis points, which translates into a higher but flatter yield curve. And getting back to the big stories of 2017, this is it. This is a great example of it. Turning to the market narrative, for the markets, this combination of raising interest rates and quantitative tightening is a large unknown factor, as there's just no precedent or past event participants can revert to as a guidepost for how this will impact the structure of the yield curve and the economy. Remember, back at the beginning of 2015, the discussion in the markets was whether the Fed would raise interest rates or reverse QE first, one or the other, not both at the same time. So now the Federal Reserve is simultaneously raising interest rates and unwinding their balance sheet. Currently, the market narrative on the Fed remains that the central bank will raise rates gradually, but maybe not at the pace that the Fed members forecast. Along with quantitative tightening, this will lead to a gradual tightening of monetary conditions and not likely be disruptive to either the economy or the financial markets. However, there are things complicating expectations in 2018. First, the Fed will have a new chair in February, Jay Powell. Second, the impact on the U.S. economy and federal borrowing via the passage of the U.S. tax reform. And number three, how aggressive will other central banks be in either their tapering or quantitative tightening? Now, these factors will likely lead to an intense scrutiny of every FOMC meeting and any changes in the language or policy contained in the policy statement. And the next Federal Open Market Committee meeting will be on January 30th, with the decision made on January 31st. Whew! That is a lot of info on just one of the major themes in the financial markets we watch. Now again, look for our publication to come out soon. I'll tweet about it from @MIBCFTC when it's released. So this week's show is a little different. I hope you enjoyed it. And that's a wrap for now, but we'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Busch. Thanks for listening. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.